All right, let's talk about Terex. Their recent Q3 earnings call was, well, it was a wild one. It started off like any other, a standard financial release, but then, boom, a massive strategic pivot that sent the stock absolutely spiraling. So let's break down what the heck happened. And when I say spiraling, I mean it. A 17% drop in one day. That's the market's verdict on everything Terex had to say. So the big question is, what could possibly happen on an earnings call to cause a reaction like that?
Okay, so section one, the headline, and it's a classic beat and miss. Before all the drama, we got the actual earnings report, and honestly, it was a pretty mixed bag.
So let's look at the numbers. The contrast here is really interesting, right? On the one hand, you've got a solid earnings beat of $1.50 a share. Way better than Wall Street was looking for. And check out that free cash flow conversion, 200%. That's just fantastic. It means they're absolute wizards at turning profits into cold, hard cash. That's a huge plus. But then you look at the other side. Revenue? A slight miss. Okay, not great, but not a disaster. The real red flag, though, is that book-to-bill number, 72%. For a company like Terex, anything under 100% is a bit of a worry because it means new orders are slowing down. So 72, yeah, that's a pretty loud warning siren.
And what's kind of strange is that even with those mixed signals, management comes out and says, nope, we're sticking to our full-year guidance. They even said they're absorbing a pretty hefty 70-cent hit from tariffs. So going into the call, the picture is confusing. You've got a messy quarter, but management sounds weirdly confident. Turns out this was just the appetizer before the main course. And that brings us to section 2, the bombshell, a new Terex. Because honestly, you can just forget about those quarterly numbers. Management was about to drop an announcement that would completely change the company as we know it. Right in the middle of the call, the CEO, Simon Mester, gets on and just drops this on everyone, a massive merger with Rev Group. The idea, he says, is to completely pivot the company away from its old, cyclical businesses and move into stuff that's way more stable. We're not talking about some small bolt-on deal here. This was a plan for a total ground-up transformation. And this thing has a lot of moving parts. It's like a 4-part chess move. Step 1, the merger itself with Rev Group. Simple enough. Step 2, the ownership. Current Terex shareholders get 58% of the new combined company. Step 3, and this is a really big deal, they're planning to completely ditch their legacy aerials business. Just sell it off or spin it out. And finally, step 4, they're promising $75 million in cost savings from putting these two companies together. I mean, this is a massive, massive undertaking. Now, you're going to hear this term pro forma thrown around a lot with deals like this. All it really means is management is giving you a hypothetical look at the books. It's them saying, hey, if everything goes according to plan, this is what the new company's finances should look like. Keyword there is should. It's a forecast, not a guarantee. And that distinction is super important for what happens next. Which brings us to section 3, the verdict, a 17% plunge. So, yeah, if this plan is so brilliant and transformational, why on earth did this stock get completely annihilated? And look at this trading volume. This wasn't just a few nervous investors hitting the sell button. No way. Volume exploded to nearly 3 times the daily average. We're talking 2.4 million shares traded. That tells you big money, the institutional guys, were heading for the exits. This was a high-conviction sell-off. So that's the multi-billion-dollar question, isn't it? Why did investors punish the stock so hard? What did they see that management was either missing or just hoping nobody else would notice? Well, it really comes down to a whole wall of worry. First and foremost, execution risk. I mean, think about it. You're trying to merge with one massive company while at the exact same time you're trying to sell off another huge piece of your business. That's not just walking a tightrope, that's juggling chainsaws while walking a tightrope. And on top of that, there's no clear timeline for getting rid of the aerials business, which just creates this huge cloud of uncertainty. And remember, all this is happening while they're already dealing with a revenue miss and those tariff headwinds we talked about. It's a lot. And this really sets up the core conflict here. Section 4, management's case versus market risk. You have this huge disconnect between the story management is telling and the story the market is believing. So you've got these two completely different narratives. On one side, you have management's argument. They're saying, look, we're creating a much more stable, less cyclical business. We'll be focused on stuff people always need, like emergency vehicles and garbage trucks. Plus, we're going to unlock $75 million in value. That's their story. But then you have the market's fears, and the market is screaming, this is way too complex. The risk of messing this up is huge. Just the uncertainty around how and when they'll sell the aerials business is enough to make most investors run for the hills. It's a classic case of vision versus reality.
All right, so where does that leave us? Let's move to our final section, the next call and the trade. How do we put all this together into an actual investment thesis?
So for us, the reading here is a clear underperform. The market has spoken loud and clear. If there's one thing Wall Street hates, it's uncertainty. And boy, has this deal created a ton of it. Here's the bottom line. For the next, say, 12 to 18 months, the story for Terex isn't going to be about how many widgets they sold. It's going to be all about one thing. Can they pull off this insanely complex transaction? The whole narrative is going to be dominated by the risks of the merger and, most importantly, the divestiture of the aerials business. Until there's a clear value-creating plan for that division, this stock is probably going to underperform its peers. And we're already seeing it. Since the announcement, the stock is trailing the S&P 500 by more than 12%.
So what's the trade? Well, the idea here is to have a short bias stance. You could go for an outright short position or maybe a pair trade where you short Terex against a basket of its more stable, less complicated industrial competitors. And what are you waiting for? The catalyst to get out of that trade would be a crystal clear announcement about the aerials exit. We're talking details on the structure, the timing, and a price tag that the market actually likes. But until that day comes, uncertainty is king, and that's likely to keep a lid on the stock.
And as always, please remember this is not financial advice.